Welcome to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Maine Financial Group. To our viewers at home, we have a very important show for you today. We're going to talk about the importance of knowing how to dodge pitfalls in your retirement. When it comes to roadblocks, you want to be able to get around them with ease. And a lot of people have questions about how do they get past these roadblocks. We really feel like whether you're 5 or 10 years away from retirement, it looks like it's going to be a challenging year for investing. So today's show is going to be all about that. How can we dodge those retirement pitfalls, if you will? But first, before we get started, Jordan, how are you?
Very well, excited to be here. How are you?
Excited to be here as well. Thank you for asking. And Adam, how are you?
I'm doing great because I'm wearing my tie that my daughter gave me, a Michigan State tie, so go green.
Wait a minute, I'm wearing the wrong colors.
Oh, you are wearing the wrong colors.
This is the University of Michigan.
See, we never plan ahead what we're wearing, so this is so cute.
Never plan ahead.
Well, before we dive into this show, let's give the viewers a little bit of your first job. Let's talk a little bit about it. Do you remember what your first job was? And most importantly, do you remember how much you were paid?
Yes, Yaya's Chicken. 15 years old, or 14 and 15, my mother would drive me to and from work, and I made $3.26 an hour.
Oh, wow.
Yaya's Chicken?
Yeah, great chicken.
Yaya's, is it still around?
It is,
It
but
is.
it's a Greek chain. But yeah, it's great.
Pretty good chicken, actually.
What was yours?
Well, let's see. Back in 1932,
Did they have color TV then?
You know, they had no TV. It was all radio. I was actually my real first job was I was a delivery boy for a pharmacy, and the reason I did it is that my dad, the Shermanator, said that if I got a job that required a car, he would help me buy a car. So I ended up getting a Datsun B210 that was baby poop yellow. But at any rate, $2.35 an hour.
Wow.
That was minimum wage.
My gosh, that's
And
amazing.
what about you?
My first job was at Cedar Point, Sandusky, Ohio. I used to love working there. I was 15 years old. Yes, you could work back then at 15.
That's right.
And I was in the birthday game. So when you actually rolled the dice and people put money on different months, I'd call out March. That's how I started in TV.
Now look at you.
Now let's think about it. But I can't remember how much I got paid. I wish I could remember that. It was very, very
Enough to buy an
little.
apple lady. Oh, that's a previous episode.
Yeah, we won't talk about that episode again. So let's talk a little bit about, retirement should obviously be the golden years. Everyone looks forward to it, but so many people hit these financial roadblocks. What are the biggest ones that catch retirees off guard?
Yeah, I think right off the bat, you have to look at taxes.
Yeah.
I mean, here is the silent killer in your portfolio in retirement. So many people overlook the tax planning. The IRS is your partner in your retirement accounts, and we want to get Uncle Sam out of it as much as we can.
Yeah, absolutely. I think that's a huge roadblock. I also think people planning, trying to live an accumulation phase of their instead of transitioning over to a distribution phase in retirement. They still think like a 40-year-old rather than trying to...
Well, that's where market loss comes involved,
Correct.
right? So that's a roadblock. Well, you have your plan set, and what if you have we've seen some volatile markets over the last few months. That would be a huge hurdle to try to get over. And I think also you got to look at healthcare in retirement as a roadblock, right? Long-term care. But what if you retire before 65 and you're not on Medicare? There's a lot of costs that come in. These are all little things.
Oh, yes.
We call them, you mentioned roadblocks, we call them eroding factors, things that can throw your plan off the road.
Yeah, and I mean, the real key is plan, right? And you can plan, but a failure to plan is a plan to fail. So come and meet with us. We will go over everything and try to get a plan in place, taxes, distribution, health care, anything that, even legacy. Some people sacrifice their retirement just in order to give their kids some money, and while I hope the Shermanator gives me some money.
Yeah.
But the fact of the matter is that we want them to have a happy retirement, and that's really the most important thing. So those can be some roadblocks.
Absolutely, and I wish there was a way for us to predict a retiree's future, because how often do you see them actually underestimating their retirement expenses?
Oh, all the time.
Well, let's just say if you've ever been to a Walmart, and you've walked in and there's a greeter there, and it's usually a very elderly person.
Yes.
Now, she or he is not there because they are choosing to be there. she's there or he's there because they've made some mistakes in the retirement. They have to be there. And Walmart is one of the few companies that hires that demographic. So whenever I do walk into a Walmart and I see someone there pushing the carts or greeting people, I feel a little sorry in the sense of, I bet a few different early changes in her strategy or his strategy might have made a big difference in that. So that's a very important stat.
Yeah, I mean, it's very, very difficult to predict the future. It really is. And the further you go out from the point that you're at now, the harder it becomes to predict. But if you don't have a plan in place, then you're just kind of doing it as an if. It's an if.
Yeah, what do they say? A goal without a plan is just a wish.
Yeah,
that
right?
is very true.
You know, the biggest fear for all retarees is screwing up and living too long and outliving their money.
Yes.
And that's why it's so important, as Adam said earlier, is to have a written plan.
Yes.
You know, the funny thing is, I remember when we used to plan if you didn't live long enough. Remember that? We used to plan for that. And now it's just because everybody's there's a good odd that if you're married, one of the two of you, I think it's a 75% odds is going to make it into your 90s.
Wow.
So you're not talking about a 15-year retirement, possibly a 20, 25, 30-year retirement, depending on when you retire.
Wow.
Right. I saw a headline, which we don't know if it's true or not, but the headline stated last year that more people turned 90 into their 90s than actual babies born in America. Now, I don't know if that's true or not, but boy, it got you thinking to think that that generation is living so much longer.
Well,
Most
it sounds
definitely.
true.
Oh, okay, great.
Well, when it comes to people fearing running out of money, I have to ask you, what risk are they taking? Are they not factoring in inflation? Is that something that could be a risk that's putting them in a detrimental category?
Yes. I mean, I think inflation is a factor. I think taxes, again, is a great factor because they're not realizing, you know, even if they don't need it, by the time they turn 72, 73, 74, 75, now Uncle Sam starts saying, hey, let's have some of that money called required minimum distributions, and they're not taking that into factor. And that can also affect their Social Security.
Right.
And how does that work?
Yeah, absolutely. A lot of people don't realize that their taxable income of you look at your tax return above Social Security is going to impact how much of your Social Security becomes taxable. So it's all kind of interconnected. But I see one of the biggest mistakes when people come in is they don't have a written plan for their income. They've got an income guess, right? Yeah. And we talk about this all the time, and we'll ask new people when they come in, what do you think you can take out of your portfolio and never run out of money? And they'll throw a number out, and we can go do our research, and we have a lot more tools than maybe they have access to. And 9 times out of 10, we can show them how to get significantly more income and have it guaranteed versus guessed.
Yes.
Yeah, in fact, we just had somebody come in not too long ago that was figuring that they could pull $5,000 a month. I wish they could pull $50,000 a month, but $5,000 a month. So that's $60,000 a year out of their retirement without, you know, basically without them losing the entire retirement or living too long, as we say. We did the research. We doubled what they could take out. In other words, we went from $60,000 a year to $120,000 a year, just with a little bit of maneuvering, and that was guaranteed income for as long as they lived. So needless to say, they were very, very happy.
Yes, absolutely. Well, we should make some more people happy at home. There's a very special message that you have, Jordan. Let's talk about what that is.
Yes, absolutely. We have an offer for everyone listening to or watching today to call the number on your screen or click the QR code and come in for a 2-meeting process to get your own customized, what we call Maine Money Report. And we use this acronym RIPT, to get your retirement plan ripped, R-I-P-T. Get ripped like Adam. Look at these muscles here. The R stands for make sure that your risk is aligned with what you want your portfolio to be. We use the analogy, what, Adam, of driving?
Driving.
How fast do you want to drive your portfolio? If you're a fast driver, are you taking that much risk or vice versa? Let's make sure your risk is aligned. The I is an income plan. Let's make sure that you don't have an income guess, that you have an income plan and it's maximizing what we can get out of that portfolio. The P stands for portfolio evaluation. Make sure you have a healthy portfolio. Go to the doctor, right, Adam?
And risk test, or I'm sorry, stress test it.
Yeah, we want to stress test your portfolio. I need to go get a stress test, by the way, run on the treadmill. And the last one we talked a little bit about was the T for taxes. Make sure we get Uncle Sam out of that retirement account. So give us a call and come see us.
Jordan, thank you. Adam, thank you. To the viewers at home, this is your opportunity to go ahead and get ripped. That number is 888-462-7839. That's 888-462-7839. Or you can grab your smartphone, click on that QR code at the bottom corner of your screen. That'll take you right to the landing page, and you can schedule your time accordingly with Maine Financial Group. We're going to take a very short commercial break. Don't go anywhere. We're talking about some roadblocks and pitfalls that people may hit in retirement, and most importantly, how can you avoid those? Stay tuned.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client, and this broker would advise our mutual client to buy, sell, and never do any tax strategy, and I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy, and the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America. So a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to the Maine Money Show. My name is Cynthia DeFazio, joined today by Jordan Maine, president of Maine Financial Group, as well as Adam Freund, CRC at Maine Financial Group. We're talking about how you can avoid these financial roadblocks that can get into your way into the retirement years. Today's all about finding solutions so you can get around them with ease. Gentlemen, we've spent some time in prior episodes talking about the risk of being a DIY investor, do-it-yourselfer. So let's talk a little bit about that. How does poor investment management overall become a roadblock in retirement?
Well, again, I think it goes back to having the mindset of accumulation. We've gone through, you probably started working in your mid-20s, and the whole goal was to accumulate, build up that retirement. And they've gotten used to maybe picking out their own investments in 401ks, or if they've moved jobs, or maybe they put it into their own IRA. And now what they're doing is, as soon as they enter in retirement, they think they can use the same principles of accumulation, and yet they're in a distribution phase. And we use the analogy of climbing up a mountain, right? And why don't you take that part, because this is your favorite story.
Oh, yeah, we use the analogy of your financial life cycle is like climbing a mountain. On the way up, your accumulation years, you're earning, dollars are flowing into your portfolio, so ups and downs in the market don't necessarily disturb you as much. You got to get to the top of the mountain, close to retirement. You've got different clouds around you, which are buckets of money and decisions to make, Social Security, pension, or such. But really, the goal is to get down the mountain, which is retirement and distribution planning. And that is in real mountain climbing. We've talked about this in other shows. 94% of all deaths that happen are on the way down because people haven't changed their fundamentals and their principles going down. So it's a big mental mind shift for people to get into retirement and to, what we say, preserve your wealth preservation, and put together an income plan.
I also think, too, like do-it-yourself Roth conversion type of things. That's kind of a scary topic.
Yes.
I don't think that I would want my CPA, I would want my accountant to be involved in that.
Yes.
And I know that we also have a website where people can go. And again, this is something that
we've got a great tool online if for your first time watching our show. It's maintaxbill.com, and it's an easy-to-use Roth IRA conversion calculator. You only have to put in a few pieces of information. What is it? Your age, your amount of pre-tax dollars, retirement account, what tax bracket you think you're in or will be in, and what rate of return you want to use. And it'll give you a report to show you if you do nothing, this is how much you're going to pay in tax versus if you convert to a Roth. It's a great tool. Check it out.
And guess what, folks? You can do it over and over again. So maybe you want to do it at 25% tax bracket, 30% tax bracket, 35% tax bracket.
I think to go back to your question, though, about the DIY, is what I see, it's a junk drawer. Do you have a junk drawer at home, Cynthia, where you have a bunch of different things?
Yes.
When we see DIY investors that come in, all they have is a financial junk drawer. They have a lot of accounts, but they're not working together. They're not efficient. Like each bucket of money should have its own little mission that's part of the macro plan, right? If it's reduce taxes or make sure we're not triggering excess Social Security tax or Medicare tax, every account should be working together, but each account should have its own mission. Does that make sense?
It totally makes sense. So kind of like tools in the toolbox, if you will.
Yes.
Yeah.
Okay, absolutely makes sense. Well, let's talk about the elephant in the room. Long-term care. No one really wants to ever talk about that, but why is failing to plan for long-term care one of the most dangerous mistakes that people can make?
Well, I mean, if you don't plan for long-term care, first of all, the odds of us living longer, which I guess is a good thing. I mean, medicine has kept up. I know my dad at 86 now is not the same 86-year-old as my grandfather who made it into his 80s as well. So they're living longer, but not necessarily, they need more help. So long-term care comes into a factor. And let's also talk about this. People don't want to go right from the house into a nursing home. They want to be able to stay at home as long as they possibly can, then maybe go into assisted living, and then maybe the last resort would be a nursing home. So how do we plan for long-term care? Again, not one of us knows the future, but if we plan ahead of time, and we're not saying to go out necessarily and get long-term care insurance.
Well, if we look at that, I don't mean to interrupt you, but at the end of the day, the cost of long-term care, at least here in Michigan, is significant. I don't know how it is in North Carolina, but it is to a point where it's becoming cost prohibitive.
Right.
So insurance companies, in traditional fashion, you would buy a policy and they would charge you a premium, like your health care, your auto insurance, or what have you. Well, that's gotten so hard for insurance to cover, they've raised premiums, and there's only a handful of carriers still left in that space. They've all gone from a premium-based long-term care policy to what's called an asset-based long-term care. So you can put a chunk of money, like a savings, into this plan. They'll give you a rate of return like if it was a bank account. They'll have the ability that you can draw so much, so many times 2 or times 3, depending on your age, for long-term care, and there'll be a death benefit. So it's kind of like a three-headed horse there. But the insurance companies have seen we can't keep up with these costs as well. There are a lot of other tools that you can use as well to plan for long-term care. Some life insurance policies now will let you take some of the death benefit out while you're alive to use for either in-home health care or in a facility care.
That's incredible.
So that is so if you don't ever use it, you still have your life insurance policy, or maybe you take a portion. So there are every year new innovations are coming out in that space.
And let me just add one more thing to that too. I know that there are a lot of people out in the audience that may not be the healthiest that they've been like right now.
Sure.
There are indexed annuities out there that also have long-term care, or I can't remember what they call it, but it's the six activities of daily living. If you can't do two of the six, feed yourself, dress yourself,
bathe.
It will double your income.
It will double your income. So there's a lot of different coverages out there, and people need to be aware of that.
Absolutely, absolutely. Talking a little bit about the failure to tax plan in retirement, how is that detrimental before we take our next commercial break? Wow.
It is
Pay tax guy.
Yeah, it is the biggest, what I think is the biggest killer investments, because if you look at it right now, we're in, I think it's the third lowest tax bracket in our history, right? So taxes are on sale right now, and they're set to expire at the end of 2025 unless they're kicked down the road. And what are the two things that happen when they expire? We go back to the rates we were in 2016. It's a double whammy because each bracket gets shrunk down as well as each bracket has a higher percentage. So you will be paying a higher percentage on a much lower amount of income, if that makes sense. So the idea right now is explore Roth IRA conversions. We've talked about maintaxbill.com in the last segment, and I think it's something everyone should look at. Taxes are on sale. Let's get the Uncle Sam out of your retirement and into some tax-free savings.
Let's talk again about the offer, Jordan. It's that time.
Yeah, we talked about get ripped like Adam here. Get your retirement accounts, your financial plan ripped. The R is a risk evaluation. Let's make sure you're taking the amount of risk you want, not too much or not too little. Let's make sure you've got a great income plan. What do you think you can take in income? We can show you. Maybe you can get a little bit more with some cool products that we have. And a portfolio analysis. Let's stress test that portfolio. Are you paying too much in fees? Are you getting a good rate of return? And then lastly, we just talked about taxes. Let's make sure we get Uncle Sam out of there.
Absolutely, Jordan. Thank you so much. Adam, thank you so much. To our viewers at home, for your very own Maine Money Report, call in today, 888-462-7839, 888-462-7839. Grab your smartphone, click on that QR code at the bottom corner of your screen. That takes you right to the landing page for Maine Financial Group. You can claim your spot accordingly. Most importantly, if you are very curious about what your tax burden could be, don't forget to visit maintaxbill.com. Put in a little bit of information, and we think that you will be very surprised at what your tax burden could be. Make some changes today. We'll be right back after this very short commercial break.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
And welcome back to the Maine Money Show. My name is Cynthia DeFazio, joined today by Jordan Maine and Adam Freund of Maine Financial Group. And we're talking all about the road to retirement and how you can bypass some of the roadblocks that could trap you and keep you stuck. Well, this next one, gentlemen, this is a very interesting point that we would like to make, talking about the importance of having a proper withdrawal strategy, knowing where to take money from and when. That seems to be so confusing. How do you help people avoid that?
Well, I mean, if we only had a crystal ball, we could probably do something
Well,
with that.
I think that there are three tax buckets that people don't really understand. Uh-oh.
What is going on here?
A crystal ball, Adam.
We can predict the future now? This is fantastic.
Compliance, please don't listen.
Wait a minute. Hold on a second. I can see it. I'm getting a message.
What does it say?
It says, sis boom ba. Sis boom ba. Oh, wait. Another message. What is the sound an exploding sheep makes? Thank you.
This is my crystal ball.
There you go.
Right here. But back to your question, Cynthia, I think
Withdrawal strategy.
It's imperative for people to understand there are different types of tax buckets and then different types of tax generated out of that bucket, right? So our retirement accounts are what's called a pre-tax bucket, right? The next bucket down we call after-tax bucket, also non-qualified. Then the last bucket is tax-free, right? Yep. But Adam, in that pre-tax bucket, when we take money out of our retirement accounts, do we get a nice cushy capital gain tax?
Heck no.
No, we get ordinary income tax. That cushy capital gains is for the after-tax dollars. Now, what about the tax-free bucket?
Tax-free bucket, you get tax-free.
Tax-free. So we always say make sure that you have some type of version of tax-free income in retirement. There's nothing better than tax-free. Everyone should explore a Roth IRA conversion.
Yeah, and let me just say, too, those of you that have money in your qualified accounts, which is the IRA accounts, that's where this crystal ball over here comes into effect, because we really don't know what the future means in terms of taxes, do we? But
true.
If you put the money into the Roth account, this crystal ball doesn't make...
Wait a minute. If you're in the Roth, Adam,
Yeah.
and taxes go up by 20%,
Oh, my goodness.
how does that affect the Roth?
It doesn't.
Zero.
Love that.
If the tax rates go in any direction, the Roth IRA is protected because it's tax-free. So we can't stress that enough to explore a Roth IRA option.
I love that. Roth is the hero for sure. Well, a little bit of planning actually involves people themselves, right? But what about when they fail to plan for their spouse? Let's talk about how that can be detrimental when they forget about legacy planning, beneficiary planning. How does that become a derailment?
Yeah, most of the time when people come in, the husband and wife are coming in, and they do tend to plan for each other. They're there together. They share in what their wants and dreams and wishes are for retirement. But a lot of times we hear, well, we're just going to pass on whatever we have left over. We're going to pass it on to their kids. Hey, that's great. That's fantastic. Except what? don't pass on your IRAs to your kids, and they don't plan for that. And why is that? Why don't they want to plan give that to their kids?
It's a complete tax bomb for their kids. The kids have to pay ordinary income tax on that IRA they received from mom and dad. Now, they can stretch it out over 10 years, but they still are going to pay income tax on that. But Cynthia, back to your original question about planning for a spouse, I think you have to look at everyone's individual situation, your health, your genetics. We've talked about in past episodes my situation. My wife is 7 years younger, and her family all lived to near be 100.
Wow.
We've never had a Maine male make 70. I hope to change that trend.
Me too.
Yes,
So
you will.
when I'm doing my personal planning for myself and Emily, we're strategizing to make sure that she has sufficient income for many, many years if I'm not here. So I think it's unique to everyone, and to have a written plan in place is the key.
Yeah.
That really is always the key. With only a couple minutes left of the show, I want to ask you, what is the one thing that's too good to be true for retirees? Like, what should they be staying away from right now that they're hearing that could possibly be a scam, if you will?
Oh, well, I mean, my goodness. I think my mother gets these emails on a daily basis, and we keep trying to have her not click on them. I think the most recent scam was something about Iraqi debt Mars or drag Mars or something
I know
to
what
that.
you mean, Denali or something?
Something like
Yeah,
that.
yeah.
It meant that you could buy them at a very inexpensive rate, but the government's soon going to give you $1 for every drachma or denali that you have,
yes.
and whatever it is. So we've seen this scam actually probably, geez, oh Pete, I've been out of the banking industry for over 8 years, and we were seeing it even then.
Yeah.
So that's one.
I think the biggest one is the IRS scam.
Oh.
So, here's a little tip for everyone. The IRS does not call people. They do not.
No.
They send letters, and they have phone numbers that you can call them.
Right.
Yet, especially elderly people, they get calls, you owe an IRS bill, send money here and do this. The IRS does not call you. They send you certified letters and you call them.
Yes, well, it all comes down to the need to plan properly for retirement. Viewers at home, don't fall into one of these roadblocks. Make sure you can get around them safely. How do you do that? By having your very own customized Maine Money Report. Call in today, 888-462-7839, 888-462-7839. Be safe, be happy, and be blessed. We'll see you back 1 week from today. Thank you for spending time with us.